Every empire was built on risk, but who first learned to sell it? From stormy voyages to crowded coffee houses, from quills to quantum algorithms, this is how the world's greatest invention began: the stock exchange.
You are watching Olives and Finance. We are simplifying finance for you.
Glowing screens, illuminated charts, algorithms that can build fortunes in milliseconds. Billions made and lost while sipping your morning coffee. But it wasn't always like this. To understand how the world learned to trade wealth, we must return to an age when risk sailed on the waves. Meet Henry, a London merchant. His ship, the Golden Swan, is bound for Asia, carrying silk and spices. A single voyage could make him rich, or ruin him forever. For one storm, one pirate, one mistake could sink not just a ship, but a man's life. And so, merchants sought a way to share risk, to let many men own a piece of a voyage, instead of one risking it all. Thus began the first investment partnerships, the ancestors of our modern stock exchange. A British-American historian, Niall Ferguson, mentioned in his book called The Ascent of Money that before Wall Street, there were wooden docks. Before bankers, there were captains.
Insurance. The insurance industry developed over the century. It goes actually all the way back to ancient Rome, but only minimally. People didn't have the concepts until the 1600s, when probability theory was invented.
In 1688, a man named Edward Lloyd opened a modest coffee house on Tower Street. His customers were not poets or nobles, but captains and traders. The air smelled of roasted beans and ambition. Here, in the dim glow of lanterns, they discussed voyages, ships, and fate. They began signing contracts. I'll insure your ship for £10 if it sails safely home. Each signature on a parchment represented trust and risk shared among men. Soon, Lloyd's coffee house became more than a cafe. It was an information hub. News of shipwrecks, arrivals, and storms spread faster here than anywhere else in London. Merchants relied on Lloyd's not just for insurance, but for truth. An English journalist and historian, Godfrey Hodgson, mentioned in his book called Lloyd's of London, A Reputation at Risk, that from a single shop with a ledger to a global market of insurers, Lloyd's is the oldest financial institution still alive today.
And in the city, for instance, like Lloyd's Coffee House, Edward Lloyd's Coffee House, which started off in Tower Street, I think, and moved to Lombard Street in 1691, and that attracted almost straight away merchants, ship owners, people who wanted to offload risks and other people who wanted to take risks on their behalf in the 1690s. And Edward Lloyd saw that this was a good market, and so he published the Shipping News in 1696, and it became the regular place for people who wanted to insure or have insured ships in the 18th century. Started off in Tower Street, I think, and moved to Lombard Street in 1691, and that attracted almost straight away merchants.
From these tables of oak and candlelight, a new world was being written, where risk could be measured and fortune insured. Across the sea, in the Netherlands, the idea of shared ownership was taken to another level. In 1602, the Dutch East India Company became the world's first joint stock corporation. Instead of investing in one voyage, investors could buy shares in the entire company. Profits were shared as dividends. Risk was diversified. For the first time in history, ownership was divided into paper shares: tradable, measurable, and transferable. Amsterdam built a market where people met daily to trade these shares. It became the world's first official stock exchange. British financial historian Edward Chancellor mentioned in his book, Devil Take the Hindmost, that the tulip mania that followed showed both the power and peril of speculation. With Amsterdam's exchange came a new world, one not ruled by kings, but by markets. London followed soon. In 1773, a group of brokers established the London Stock Exchange, giving formal structure to what had begun in the taverns and coffee houses. It was here that fortunes were made and lost overnight, from railway companies to colonial enterprises. Britain's empire and its markets grew together. In 1792, across the Atlantic, 24 stockbrokers signed the Buttonwood Agreement under a sycamore tree on Wall Street. It marked the birth of the New York Stock Exchange. From there, America's financial story began, a story that would one day define global capitalism. Martin Harry Wolff, a British journalist, once said, "The London Stock Exchange represented not just wealth, but order, the rule of financial law." A Canadian-American economist, John Kenneth Galbraith, wrote in his book, The Great Crash of 1929, that the same street that built the dream would also face its darkest hour. From the sound of shouting traders to the silence of servers, the stock exchange evolved faster than anyone imagined. The open cry became the open API. World's most successful investor, Warren Buffett, once said, "Markets are human behavior reflected in numbers. The principles haven't changed in 400 years." The wooden counter turned into a digital cloud. Yet, at its core, the idea remains unchanged. To share risk, to trade trust, to believe that from uncertainty comes opportunity. An American economic historian, Charles Kindleberger, wrote in his book, Manias, Panics, and Crashes, "Financial crises are hardy perennials. Every age has its own crop." From the stormy seas of the 1600s to the blinking servers of today, the stock exchange remains the same timeless promise. Shared risk, shared reward, and the endless pursuit of fortune. The mechanism changed. The motive never did.